He is excited about what he can teach these grandchildren, and not just contribute monetarily, but he sees that he can build them a facility that will allow them to do so many things for their family and their community going forward that we can't even see right now. Right? They can fund charities, they can set up scholarships, they can start businesses that employ people, or they can just live a fairly comfortable life themselves.
At IB Canada Group, we are your complete and independent source on the infinite banking concept, serving Canadians from coast to coast.
Well, today I'm joined by Wayne Durksen and Glen Griffiths. Wayne out of Saskatchewan and Glen out of Alberta, and I'm Mike from British Columbia, and we're here from IB Canada Group just talking about the idea of legacy planning. And what does legacy mean, and how do you create a legacy? And we're going to talk about maybe some ways to think about using the infinite banking concept as a way to multiply your legacy, to create a legacy, and maybe some different options that you may want to consider other than infinite banking concept. So why don't we kind of open it up a little bit here, and maybe Wayne, I'll get you to maybe just let's lead us off with a bit about how you define legacy and how you would define that and what you would do with that.
Yeah, so thanks, Mike. So when it comes to legacy, I tend to like definitions. And, in its simplest form, legacy is leaving something after you're gone to future generations. And so I think it's really valuable for people to sit down and be very intentional about what exactly is it that you want to leave to future generations. And certainly we can leave the money, and probably should if we can. But there's many things we can leave for future generations if we're intentional about it. And one of my favorite questions of people is this: is the thing you're about to do going to lead you closer to or further from your primary objective? And so when I think about leaving a legacy, I realize that one of the big things that destroys our families and our homes is a lack of values, and finances are continually a stress for families. And so what does it look like for us to say, how do we actually intentionally structure our world so that we can leave behind good values and even a source of finance so that people don't have to struggle and go through the same issues that most Canadians, or frankly globally, we experience. And so people say, well, I don't think I can, or I don't know that I really want to. And I'm saying, wow, if I could help the next generation be able to fast track onto high capacity, high contribution in society, by getting rid of some of the financial stresses, pressures, and destructive behaviors, I want to do that. So how do we leave behind something like that? And part of that, I think, is just recognizing that cash and capital are not synonymous. And if we're going to leave something, then we better figure out how to preserve it, how to protect it, and how to ensure that it actually goes forward. And then that it lands in the hands of people that can genuinely steward it and leverage it, and ultimately, again, be able to pass that on in their legacy. So it's kind of my heartbeat.
Yeah, right on. Actually, it's interesting you brought up so many great points there, Wayne. One question I'd like to maybe circle back on that you just said is that cash and capital are not synonymous. And I know that we've got a few other videos out there that talk about that, but I don't think that we can talk about it enough. Can you maybe just go into that definition of why you think cash and capital are not synonymous?
So I think cash tends to slip through our fingers, and we're not mindful of what's actually happening. And money's got to flow. Just like blood's got to flow or you die, water's got to flow or it becomes stagnant and poisonous. Well, money's got to flow. And we don't actually sit down and contemplate that very much as to what is actually happening with the flow of money. But the very fact that we're ignorant of it doesn't mean that it isn't happening. And then if we start to understand that cash and capital are not synonymous, then we probably better add definitions. So when I think about capital, and this comes from Ryan Griggs, who is just this amazing economist out of the US, who really triggered this for me. But capital has an acquisitive component to it. It has the ability to reproduce. Every day of your life, with every beat of your heart, capital will grow. And so if you understand that, why would you ever part with something that is appreciating, that is growing, that is and potentially available to be transferred forward? So when I think about capital, I get jazzed right up. I'm going, I need to preserve capital and figure out how to use it, but not lose it.
Yeah, 100%. Glen, do you have anything to add on to that definition of legacy. I think Wayne really summed it up, but from your perspective, how would you define legacy? And maybe you can answer this question: why is legacy important to you?
Well, thanks, Mike and Wayne. Fantastic job, Wayne. You know, when you talk about values, right? Legacy, yes, it's leaving something behind. But when you talk about values, establishing your values allows you to get in the frame of mind to actually leave something behind. And you talked about stewardship. Not only do you want to just leave it behind and hope they continue, but part of stewardship is you're going to give them the tools and teach them how this works so they can continue to build that legacy as well. Right. And I love that. I love the continuity. I love providing opportunity, but that requires that you're very intentional with what you do, which we are, and that stewardship requires that you actually do some handing down of information, right? Some transfer of information. So not just the capital that we leave behind, but the how do we acquire, grow, and then pass that on so we can continue to build our values, spread those values out to those around us, and the opportunities that come to that. So yeah, fantastic job defining that way.
Wow, that was a mic drop. But stewardship really is and the idea of stewarding, we don't steward our cash. We have to, the only thing we really steward is our capital in financial terms. So that comes back to the synonymous definitions, or the non-synonymous definitions of cash and capital, the differences. It's impossible to steward cash, but it's very easy to steward assets, capital, and I think, to both of your gentlemen's points, values, right? And I think actually one of the great books that really touches on this is Garrett Gunderson's book, What Would the Rockefellers Do? And that particular book talks about the downfall of the Vanderbilts and the absolute success, financial success of the Rockefellers, and arguably, depending on what your belief system is about the Rockefellers, but certainly one could argue the charity that they contribute to and have contributed to based on the success of John D. Rockefeller back in the day, creating his wealth. And now over 130 people are financially dependent on the Rockefeller Trust. Why? Because they understand the concepts of placing their capital in and growing their capital inside a tax-exempt life insurance contract. Now, it's different in the States, but the rules and the general theory still apply. You know, in the Income Tax Act, we have the ability to put a policy in our child's or grandchild's name and have that. If we understand the idea of compounding those values without the headwinds of tax, then where could potentially those things go? Because we're not assuming the risk, we have the money or the capital available to deploy from time to time in those investments over time. But now you start extrapolating that, instead of over, you know, Wayne and I are a little bit older. Glen's the young buck here in the room. So, you know, presumably Wayne and I would pass away sooner. So it would make more sense for Wayne to not only do the policies in his name, but to also maybe consider putting policies in his kids and grandkids' names, and even for Glen, his kids, putting those in his kids' names, and allowing that to grow and multiply over multiple generations. I think one of the interesting things, for us, speaking directly from an income tax perspective, one of the provisions that's allowed within the Income Tax Act in Canada is for me or any family to pass on these policies generationally. So I would own a policy, presumably on a child or grandchild. And then as I decide that they are now financially capable and have the financial literacy and wherewithal, and you know, they're not spendthrifts or anything like that. So now I can pass on, or I feel comfortable passing on those policies to the next generation. And through an idea or strategy called cascading, those policies can go intergenerationally without creating a tax disposition. And my kids or grandkids can now take those policies on. And Wayne, I know you're a John Maxwell fan, so I know you'll get this saying. John says, do your living while you're giving so you know where it goes. And so that's one of the abilities for us as not only practitioners, but I think very importantly, we are also IBC clients, right? An authorized practitioner should also be authorized based on the effect of in his or her own life, the ability and the execution of these strategies in their own life. Wayne, I don't know if you have anywhere that you'd like to take that comment with.
So yeah, I love what you've said, Mike. And I often say to my clients, my optimal client is 21 inches long. Uh, Give me a 21 incher and I can change the world. Give me a 21 incher and I can teach their parents how to transfer some of their value and some of their future and teach them how to generate and build cash flow and productivity. Give me a 21 incher and I'm probably going to have parents that are saying, well, that just makes a ton of sense. Can't I do this? And, give me a 21 incher and their grandparents will even buy in. And so then all of a sudden you got the corporate people saying, well, wow, if this works for a 21 incher. And so I think understanding money, the flow of money and how it all works. And then if we're going to preserve our capital, we got to protect it. We got to put it someplace that's safe. And as Mike pointed out, it seems pretty bizarre to suggest that a participating dividend paying policy, a participating dividend paying whole life insurance policy is a great storage vehicle. And I'm going, yeah, who'd have thunk that? I mean, that just doesn't make any sense. But when you start to understand the flow of money and realize, wow, I got a great place to preserve it, protect it, leverage it, legacy it, and I can, I have policies on my own grandkids, and I made their parents match ours, and so I will likely, there's a high probability I'll get to see that transfer, but I won't get to see when they transfer those very policies forward. And I'm going, wow, I'll be long gone when future generations, if our world holds together, that is, get to benefit from this. And so, yeah, it's just an incredible thing to think about legacy and how we actually, and you can't do this without thinking. Drift is never a good thing. Drift never takes us to a good place. Drift takes us to the most dangerous current in the river.
Yeah, I think that's a very good point, that if you have a policy in the name of the insured party is your grandchild, you own it, then you transfer it to your kids at some point in the future and they own it. And then they transfer it to the actual insured person, which is your grandchild today. But presumably when they've grown up, they can change the beneficiary to their grandchild or even great grandchild. So you're planning, literally up to 100 years in the future when you're putting a policy on a very young child, because you're affecting your great grandchildren with the policy that you're designing and controlling today.
And what's really cool, and I'm sure this is true in your worlds as well, but once you have a target, once you have an objective, your brain actually kicks into gear. They call it your reticular activation system, kicks into gear and begins formulating strategies to realize the outcome. So when you start thinking about this, my 6-year-old grandson phoned me last night and said, Grampy, 5 p.m. tomorrow, can we have a meeting? And so we got a Zoom meeting scheduled for tonight at 5 p.m. and I get to instill my value system in him, and I have a whole strategy because that target's been built. Now I got to figure out, how do I make sure he's ready to leverage it and maximize it and reproduce it? And I'm going, how cool is that we get to do this, and I know with a level of certainty that this is going to pay huge dividends forward.
And of course, by paying dividends, you're not meaning any pun intended there with
Yeah,
policy
no
dividends. Yeah, I think that when you take a look at some of the options, Thomas Sowell, the great economist Thomas Sowell, always asked 3 questions when he was evaluating a theory or concept or anything. And those 3 questions were, compared to what, at what cost, and what hard evidence do you have? And I want to focus just for a second on, what other financial tool or vehicle allows us this tax-free transfer of wealth. And I've heard a lot of people say, well, does my tax-free savings account do that? And I would say to a limited extent, yes. I'm actually quite a fan of tax-free savings account, not as big a fan as RSPs, but again, we're not here dispensing financial advice on what people should or shouldn't do. We're just giving some broad theory here today. But when you think about a tax-free savings account as a financial vehicle that you can use, leverage against, and grow, there's some challenges with that. Either you're in cash and not earning into, when this video is being recorded at the end of 2021, I don't think we're even being paid peanuts on cash right now in terms of interest. But if you're in the market, your margin ability on a tax-free savings account is based on the security and the financial vehicle that you're using, whether that's stocks, bonds, ETFs, anything like that. You're going to have a lower ability to put that up as collateral. But an insurance contract has a contractually guaranteed 90% of the cash value, collateral value. And so when you think about tax exemptions and you think about legacy planning, a tax-free savings account, you can name a beneficiary, but it's only the cash. With the process of banking using the platform of an insurance contract, the inherent nature of insurance contract is a death benefit, which could even multiply your wealth even further when you think about it in a death benefit perspective. Glen, I want to circle back to something that you had mentioned about the idea of stewardship. And if anybody that's watching this video has ever watched any of the Hans Hermann Hoppe talks on why monarchies are better than democracies, which are not going to get political here onto which is the best system of governance, but he often talked about his argument about monarchies were that monarchies see generations in the future, where democracies see every election cycle into the future, and that's it. They're just looking for a re-election, where monarchies are potentially looking at what is the impact of my actions today on the 100, 200 years down the road. Glen, do you have any maybe examples of clients that you've helped create legacies with the infinite banking concept, or any stories or anecdotes that you can share?
Thanks, Mike. Yes, when I have a grandfather who he's on his second grandchild now. We'd set up a policy for his first grandchild about 6 weeks in, and he called me the day his granddaughter was born. I said, well, we've got to give it 2 weeks, but we can get right on it, because he sees it, right? He's lived his life. He is excited about what he can teach these grandchildren, and not just contribute monetarily, but he sees that he can build them a facility that will allow them to do so many things for their family and their community going forward that we can't even see right now, right? They can fund charities, they can set up scholarships, they can start businesses that employ people, or they can just live a fairly comfortable life themselves. There is so many variety of things that you can do as a result of this facility. And the stewardship is not just showing them, this is what we've got for you, this is what you can do. So preserve this and then pass this knowledge on to eventually when you have your children and grandchildren, so this can continue exponentially. And I'm glad you brought up that point of a monarchy, because in essence, that's what they do. They don't just run the countries, they pass on family traditions. Right? So yes, I've done that, had a couple of grandparents like that. And for some who are newer who just want to give a gift, one of my little things I do around this time of year, I talk about grandparents. Okay, you know what? You've got the grandkids, you want to give them a gift, but you don't want to buy them another toy. It'll be done with by January 1st. You want to give them something of meaning, of a legacy that could be around for another 3 generations after. And this is where I generally will tell a grandparent, how about the gift of a permanent policy that's going to grow with them and past them? And that resonates with a lot of grandparents who've been around a while, because it's now about, what can I pass on? Not just monetarily, but what can I pass on values, as we've talked about? What can I pass on to help my next few generations be better and make more of an impact? And when we have that conversation, it generally excites them as much as I get excited with it.
So awesome.
I think one of the things that, Glen, as you were speaking, I was thinking to myself, if you're actually going to leave something for future generations, then you better teach them generosity as a core value. Because if they're not generous, greed and scarcity will consume them and destroy them. And so, why would you leave a gift that would be highly destructive versus a gift that would enable them to be a high contribution, high capacity citizen? I think one of the other things, and maybe Mike, this would be good for you to just expound on. You've mentioned it, you've certainly talked about it, but can you just spend a little time talking about compound interest and then uninterrupted compound interest compared to some of the other vehicles you were referring to? How well, maybe on a scale of 1 to 10, how well do you think people understand the value or the power of uninterrupted compound, and then maybe dissect them?
Yeah, that's a fantastic question, Wayne. And, to be honest, I don't think people understand it because how many people are actually taking advantage of lifetime uninterrupted compounding tax exempt returns? And I would say that's the exception to the rule. If back when I was in the financial institutions, I was 19 years in the banking and credit union system. And one of the things that we often saw was people that would, invest 1 year in a GIC. Well, and if you've ever known the analogy of the story of taking a penny and doubling it every 30 days, or just getting a simple income or interest, well, the power of compounding over time is dramatic. You take a penny and you multiply it by 30 periods, one penny turns into $10.7 million in total capital. Whereas if you took the $100,000, well, that's only 3 million. And we don't think about the lifetime, the duration. We're focusing on interest rate. We're focusing on, well, if I borrow money, that's an interest cost. I can't get my head wrapped around, which is very common for a lot of especially older Canadians, is they don't understand the power of leverage, or they think that leverage is somehow not something that they should be taking advantage of. Why? Because we've been taught, get a house, pay that mortgage off, get debt free, because your income's going to stink when you're in retirement. Well, rather than thinking about limiting my retirement options, I want to create larger retirement options. An RSP is designed that the government's going to force you to liquidate that over time. And not only does it liquidate over time, but you're attracting a silent partner in your estate in the event of a premature death between you and your spouse. And that partner, unfortunately, is CRA, who's going to come knocking because they know where the money's at. I can't remember the name. You guys might remember the name. And Nelson talks about it in his book, Becoming Your Own Banker, and it's just escaping right now. Oh yeah, Willie Sutton. He says, well, Willie, why do you rob banks? And he says, because that's where the money is. Well, what do you think CRA is going to do, man? They're not looking at what teenager. They're not, bumping or doing a lot of audits on 16-year-olds working part-time at a fast food restaurant. They're looking at the people that have focused on creating their wealth and not properly tax planned for their future, their estate. And I'm just like, that's number one, that's dangerous. But number two, the power of compounding. If we were to take compounding in our life, and the story I always give, and I'll repeat it again, is like an apple tree. I've done Excel spreadsheets to back this up, but if you plant an apple tree, it's going to take you about 4 to 5 years of growth, care, watering, and attention in order to produce apples. So why do we treat our bank accounts any differently? Why do we treat our pools of capital so flippantly? I would rather use a bucket and a ladder to grow my apple tree and allow that to continue to mature, rather than cut the tree down every 3 or 4 years just before it starts producing fruit. And this kind of circles back to my original point. When I was working in the financial institutions, we'd have people that would, come in 3-4 year GIC. They just start collecting a bit of interest as it starts compounding, and then they go spend the money. I need a new car. I need to get a vacation to Hawaii or something like that. And they would lose that compounding value. So I think, unfortunately, the banking system has really trained people to limit their financial literacy and not pay attention to where the real money is made. And I call real money Jimmy Pattison level money, where he's allowed Save On Foods to compound in value. He's grown, he's taken those apples and planted more and more trees, and he's grown an orchard now to where it's producing a large, not only income stream, which I don't believe he's taking an income stream. I think he's borrowing the incomes against the value of the income stream, quite frankly, and just allowing that compounding and that money to reinvest into your business. If you have a entrepreneurial mindset, you're going to take the money as seed money, the original profits from the company, and you're going to throw that back in to your company as seed money to go grow it. We always have to be growing, because what's the opposite of growth? Death. Right.
I love your Jimmy Pattison piece. Jimmy Pattison understands the flow of money, and he understands how to get it to flow in the direction he wants it to flow.
Yes.
And why would he ever hoard it or stop it? He constantly is looking for new opportunities and larger holding storage facilities to warehouse his capital so that it's available to reproduce more and more. And with that, Jimmy Pattison is one of the most generous Canadians on the planet. His philanthropic interests are astounding. And it's all because I believe he's got his value system right, and he's figured out the flow of money, and he's figured out how to let capital work without losing it or exploiting it. He just has learned how to grow it. So it's a very cool thing. And if we understood the power of uninterrupted compounding interest, it would probably be a game changer. But you really have to sit down and do the hard work of thinking to be able to sort of watch and go, hold it a second, this is mathematically sound. So why is it not practically practiced?
2 words. First word, cognitive. Second word, bias. 2 more words. First word, irrational. Second word, exuberance. So as we wrap up here, gentlemen, maybe I'll get just some final thoughts on legacy. Glen, let's start with you in terms of anything that you would want to make sure that anybody watching this video is really understanding, getting through their head in terms of understanding of the idea of legacy and using an IBC policy to execute that.
I think of my children. I think of setting them up. I think of ways in which the policy will benefit them. But again, the stewardship, teaching them what they have, teaching them so they have a thorough understanding of it. And then they in turn will pass that on to grandchildren and their children. And that excites me, that I can do something that impacts the next 4 or 5 generations of my family, right? Greatly excites me, knowing the opportunities that it'll provide for them continuously, as long as they perform proper stewardship by not messing with the capital. All right. So that just in my own family excites me, and to be able to do that and paint that picture for my clients who may or may not see that, or who are thinking, what can I do? Yeah, it'd be nice to give them something, but do I want to go buy that rental property? That's going to be a lot of headache to manage, at least when they're young. Maybe something you use the policy to do down the road, one of those things that we just can't quantify. So painting that picture for my clients and just letting them know how I see it from my own family generally excites them as well, right?
That's awesome. That is so good. And I think one of the things I appreciate about what you've said here over the last, I don't know, half hour, or whatever we've been here, is the idea of stewardship. That is such a powerful term, and I'm really glad that you brought that up. Wayne, any final thoughts?
I just think that if people were to sit down and really say, I'm going to spend a few days over even the Christmas break that's coming, where we do have a little bit of downtime, we got family, those that we love the most are with us. And if we were to start thinking about where are my experiencing wealth transfers that are happening either unnecessarily or unknowingly, and how much of that might be able to be redirected towards legacy. And then if I was going to leave a legacy, how do I actually begin to prepare my family to steward it well? I say this to provoke clients all the time. CRA is a really bad business partner. I love a lot of the amenities that we have in our nation because of taxes, but they're a really bad business partner. And so if we actually understood that, we would redirect or retool the way our worlds work, and it would be highly advantageous not only to our own lives but to our future generations. And then I suspect it would just be contagious to those that happen to watch and be close enough to experience it. And it would start a whole movement where people would take control of their finances and begin to understand, listen, I need to completely control the finances in my world and in my future so that I can genuinely make a difference while I'm here, and make sure I leave a legacy so that my bloodline can continue to make a difference after I'm gone.
Hmm. I think I'll just maybe just wrap this up by saying how important it is for people to take the education to really be invested in answering the questions that they may not know, where they may. I think it was Will Rogers that said something, and I'm gonna butcher this quote up, but he said something to the effect of, "It's not that what we think to be true. Sorry, it's not that we know to be true, but it's what we think to be true that just isn't true, is the problem." And I think that's a lot of. It comes back to the cognitive bias. It comes back to emotions. How much on a scale of 1 to 10, how much of our decisions are emotionally based? Well, it's 100% of our decisions are emotionally based, even though it may reach a logical conclusion. The logic is the emotional impact that we're looking for out of those decisions. So if you thought to be true turned out not to be true, how quickly would you want to know it? And for some people, they want to remain that ostrich head in the sand, or reinsert me back into the matrix. I should have taken the blue pill and now I can enjoy that steak. But for some of us, I think it's really about, oh, okay, now I actually come to realize that I love the way Nelson talks about Austrian economics. When he first read Economics in One Lesson by Henry Hazlitt, he says it was like the wool was pulled from my eyes and I could finally see what I should have seen a long time ago. And where the heck are you guys hiding this stuff from me? And his realization about how economics works, how the banking system works, and how we literally can use a simple but properly designed tool, and properly designed by an authorized infinite banking practitioner in Canada, to walk you through how this works with the Act, the Income Tax Act, and how this works in the Canadian landscape of insurance, in order for you to arbitrage the lost opportunity cost and interest that you are paying to third parties. I think creating that legacy requires us to pay attention to all those things. So I just, again, thank you very much, Wayne and Glenn, for joining me on this call today. And I really certainly appreciate your input. And yeah, I wish everybody that is watching this video, hope that it was of value to you, and that I would redirect any further questions that you have to the website ibcanadagroup.ca. For further information, go to our practitioner finder and look up somebody in your province, or somebody that's licensed in your province that can help you address some of these questions and build a legacy. So we'll sign off with that.
IB Canada Group, your independent authority for information on the infinite banking concept.